The savings account rates that felt like a gift 2 years ago are now declining and will keep declining. If your cash is still sitting in a HYSA waiting for rates to recover, you are making the most expensive cash management mistake of this rate cycle. Understanding why rates are falling and what that means for your available alternatives makes the difference between moving money reactively at the wrong time and positioning it strategically before the next drop arrives. There are four specific places cash belongs to right now, depending on how long you plan to hold it and how much you need it to remain accessible. Each one serves a different purpose, and each one outperforms a declining HYSA in a specific set of conditions. Why HYSA rates are dropping and why they will keep falling. High yield savings account rates are variable. Every bank sets its HYSA rate based on where it needs to be relative to the Federal Reserve's benchmark interest rate to attract deposits. When the Fed raises rates, banks raise HYSA rates to stay competitive for new capital. When the Fed cuts rates, banks lower HYSA rates because they no longer need to offer elevated yields to attract deposits. The relationship is direct, and the lag between a Fed rate decision and a bank rate reduction is typically weeks, not months. The Federal Reserve began cutting interest rates in September 2024 after holding them at elevated levels to combat inflation. The September 2024 cut of 50 basis points was followed by additional cuts in November and December 2024, according to Federal Reserve meeting records published on the Fed's official website. The HYSA rates that reached 5% and above during the peak rate environment in 2023 and early 2024 have since declined and will continue declining as long as the Fed continues its rate reduction cycle. An investor whose cash sits in a HYSA earning a declining variable rate has no protection against continued rate cuts. Each additional Fed cut reduces the interest being earned on that balance automatically and without any action required from the bank or the account holder. Alternative 1. Treasury bills. Treasury bills remain the most tax-efficient place to hold short-term cash for investors in states with income taxes, and the structural advantage from the previous video on this topic still applies, despite the shifting rate environment. T-bills are short-term U.S. government debt with maturities of 4 weeks, 8 weeks, 13 weeks, 17 weeks, 26 weeks, and 52 weeks available directly through Treasury Direct .gov or as ETFs like SGOV and BIL through any brokerage account. The critical structural advantage is that interest earned on U.S. Treasury securities is exempt from state and local income taxes under 31 U.S.C. Section 3124. HYSA interest is taxable at every level of government. That exemption does not disappear when rates fall. The after-tax advantage of T-bills over HYSAs persists across the entire rate cycle for investors in high-tax states. The strategy that makes the most sense as rates decline is a T-bill ladder. Rather than placing all cash into a single maturity date, an investor distributes the balance across multiple maturities, buying 4-week, 13-week, and 26-week bills simultaneously. As each tranche matures, it can be reinvested at the prevailing rate or redirected to a longer duration option if rates have continued falling. A ladder removes the pressure of timing the bottom of the rate cycle and ensures a portion of the portfolio is always maturing and available for redeployment without a full commitment to any single rate. Alternative 2. Certificates of deposit. The most compelling argument for CDs in a falling rate environment is straightforward. The rate on a CD is locked at the moment of purchase and does not decline when the Fed cuts rates. A bank that offers a 12-month CD at 4.5% today will pay exactly 4.5% for the full 12 months, regardless of how many additional Fed cuts happen during that period. The same bank's HYSA rate may fall to 3% or lower over the same window. This makes CDs uniquely valuable during a rate cut cycle relative to every other cash alternative. HYS, A rates, T-bill rates, and money market fund yields all decline in real time as the Fed moves. CD rates are fixed at origination and stay fixed until maturity. According to FDIC guidelines, CDs are insured up to $250,000 per depositor per institution, carrying the same federal insurance protection as HYSAs. The trade off is liquidity. Most CDs charge an early withdrawal penalty ranging from 1 to 6 months of interest for accessing funds before the maturity date. This makes CDs appropriate for cash with a defined holding period and no anticipated need for early access. For an emergency fund that may need to be accessed at any time, CDs are the wrong tool. For a cash reserve designated for a purchase or expense with a known timeline of 6 months to 2 years, locking in the current rate before the next Fed cut reduces it makes mathematical sense. Alternative 3. Money market funds. Money market funds sit between HYSAs and T-bills in terms of yield and flexibility. A government money market fund like Fidelity's SPAXX or Vanguard's VMFXX holds a combination of short-term U.S. government securities and repurchase agreements backed by government securities. These funds pass through income from their holdings as dividends paid monthly and maintain a stable $1 net asset value that makes them functionally equivalent to cash for practical purposes. Money market funds are not FDIC insured the way bank accounts are. Government money market funds, however, hold only U.S. Treasury and government agency securities, which carry extremely low credit risk by design. Their yields track short-term Treasury yields closely, which means they also decline as rates fall. The primary advantage over a HYSA is that many money market funds at major brokerages currently yield slightly more than bank HYS. As for the same liquidity and risk level, and they can be held directly inside a brokerage account alongside an investment portfolio without transferring money between separate institutions each time it is needed. Alternative 4. Short-term bond ETFs. This is the alternative that rewards investors who understand how interest rates and bond prices interact. When the Federal Reserve cuts rates, existing bond prices rise because the fixed interest payments those bonds represent become more valuable relative to newly issued bonds paying lower rates. Short-term bond ETFs like BSV, the Vanguard Short-Term Bond ETF, with an expense ratio of 0.04%, hold bonds with maturities between 1 and 5 years and benefit from modest price appreciation when rates decline, in addition to the income they generate from the underlying holdings. The trade-off relative to T-bills and money market funds is that short-term bond ETFs carry some principal fluctuation because their net asset value moves with interest rate changes. They are not appropriate as an emergency fund or for cash that may be needed at a specific date, because the value of the position at any given moment depends on where rates are at that time. For cash with a 2 to 5 year horizon that does not need to be accessed at a precise date, a short-term bond ETF participates in price appreciation as rates continue declining rather than simply earning a yield that passively follows rates downward. The framework by timeline. For cash that needs to be accessible within 30 days, a money market fund or a very short T-bill provides full liquidity with better yield than most HYSAs at current rates. For cash that will not be needed for 1 to 6 months, a T-bill ladder captures the state tax exemption advantage while keeping maturities short enough to maintain flexibility for redeployment. For cash with a known holding period of 6 months to 2 years, a CD locks in the current rate before additional Fed cuts erode it. For cash with a 2 to 5 year horizon that does not need to be accessible at a specific date. A short-term bond ETF captures both income and potential price appreciation as rates continue falling. AHYSA earns a declining variable rate across all of these scenarios with no specific structural advantage in any of them. Matching each category of cash to the appropriate alternative for its actual holding period is the entire strategy. Rates dropping is not a reason to panic about your savings. It is a reason to be deliberate about where each category of your cash is positioned, because different alternatives win in different parts of the rate cycle, and the HYSA wins in almost none of them when rates are in decline. The tools to do better are straightforward, available through any standard brokerage account, and none of them require predicting exactly where rates will ultimately land. If this breakdown helped you think more clearly about where your cash belongs right now, subscribe. Because every week we work through the financial decisions that most people face without a clear framework for making them.